Good morning, my dear friends, students, aspirants of CFA, FRM and other bankers. Today we are going to discuss about the current valuation of stock market, Indian stock market specifically, how to go about it. The Nifty is touched 50,000, Sensex is touched 50,000, Nifty is crossing 15,000 levels, right? So is it a right valuation? Is it okay for us to invest at a 50,000 level of Sensex or 15,000 level of Nifty? Because it's always a worry. Are we getting into the market at higher valuation? Because there was a myth, or there was always a thought process, we should always buy low and sell high. Right? This is the basic fundamental understanding or the thought process with every investor having it. Buy low, sell high. But most of the retail investors always getting high and buy high and sell low. That is a mistake which always they do that. But is it possible for anyone and everyone to find out the low of a stock market? 7,200 on the Nifty is low, or 2,200 is Nifty is low, or 15,000 at Nifty is high, or 14,000 is at high, or 20,000 is at high. We are not sure about it, because the stock market indexes like a Nifty, Sensex is a barometer of economy and other macro environmental factors plus the other newses which is available in the market, right? Please understand, the market behaves based on multiple factors, not one factor or two factor or 10 factors where we can able to just identify. If we can able to understand and identify the trend, we need not work anywhere. We can do only a trading in the market, make plenty of money. That is not possible in the stock market. Especially Indian stock market is quite unpredictable, like like any other market, but your Indian stock market is little more tricky to predict, because there are a lot of events which is happening in India. It's a developing economy and growing economy. Still we have a lot of things to do in the Indian economy, and the economy is growing, right? Even a month before or 2 months before in my video, I was talking about the impact of COVID-19 on Indian economy. I was talking about two major issues. We had a supply side issues, we had a demand side issues during the COVID-19 pandemic. Especially in 2008, it was a different story. We had a financial crisis, especially in the banking system, and banks have gone into bankrupt. We were able to know what will be the impact, and then we came out and the market was slowly moving up from 8,000 to 24,000, 24,000 to 48,000. Now it has crossed 50,000 in Sensex. But COVID-19, the coronavirus pandemic, something unique in nature. We had a problem on demand side as well as supply side. It is not just easy one to identify when this pandemic will get over, what will be the impact on the economy, how the market will respond and react to this kind of an event. So it was quite difficult. No one has expected the market moves from 7,000 to 15,000 in Nifty and gone back from 36,000 or 32,000 of Sensex back to 50,000 in a short span of time, right? It was quite surprise for most of the people. The reason behind is the market is driven by the liquidity, not by the fundamental. So many people have asked me, Hari, you were talking about economy was not good because of the COVID-19, coronavirus, all these things, the corporate results was not up to the mark. Yes, still that conditions are remain same. There is no change. But market is a market. Market moved up on account of liquidity. As long as this liquidity continues, this market will continue to move up. So now what to do? We need to check this is the time to check. There are three decisions you have a place to take. One is, can you hold your investment, whatever you have invested on last year or year before or 2 years before? Second thing is, can I invest now? Third thing is, if my decision is hold my investment, my decision is to do further investment, how to do that? These are all the three questions we need to answer looking at the current market situation. There was another question the people were asking it. Not all the stocks are moving up, very few stocks are moved up. So what to do on this? Is it possible for us to identify those stocks? Can we invest on those stocks? Or we can invest on a broader based mutual fund or a multi-cap fund or a flexi cap fund where we can do invest and wait for that. How to do that? Selection of stock is very difficult at this kind of a market situations. 4 months before, I have given a recommendations to buy Tata Motors at 120 rupees per share, expecting the Tata Motors will touch 300 plus in 3 years time. But what has happened? In a 6 to 7 months time, the Tata Motor has grown up from 120 rupees to 280 rupees, 290 rupees now. Right? That is the level of run up which has got. What was predicted? In a 3 years time it will touch this much of price increase, but which has happened in 6 to 7 months time. This is all because of a continuous liquidity. There was a huge demand for the particular stock to move up. Can we able to say that it's the same way other stocks also moves up? My answer is no to that. It is very difficult to identify a stock which grows up 200 to 300% in 6 months time. Right? So what we can do now? My suggestions to all my friends and investors to put your investment stay in the equity market. In the long run, our Sensex will touch 1 lakh mark in a long run. Long run means how many years? 4 years, 5 years, 7 years? My view is anywhere between 5 to 7 years it will touch. That is the maximum timeline I am just keeping in it. That means Sensex will double in 5 years time. That means compounded annualized growth rate. We call it as CAGR. Anywhere between 15 to 16.6%. That's where it grows 2 times or double it from 50,000 level to 100,000 level in a 6 to 7 years time. But short term correction is possible? Market is going to be volatile? My answer is yes. It is inevitable. Please accept that. Any market which has run up has to come down. It has to come down. If it is continuously going, it is not healthy sign. Any market which has come up, it will come down. When it will come down, how much it will come down, it is difficult to predict. But volatility in the short term, my answer is yes. Volatility maybe goes up and goes down. Higher volatility, higher risk. Higher risk means higher return. So the market has come up to the level of 15,000 in Nifty, 50,000 in Sensex. It will come down probably 10%, yes, 15%, yes, 20%, yes. Yes, probabilities are there. But stay invested. That is for the investment you have already made. Wherever you want to book profit and keep the cash in hand. Whenever the market corrected more than 15%, infuse with the right stock or right selection of mutual fund in equity, and the market will take care of other things. Right? That is the answer to the first question. Answer to the first question, may I stay invested? My answer is yes. You stay invested, the market will go up in a long term. You can make returns, positive returns. Yes. Wherever you made a profit, book profit, keep cash in hand. When the market corrected by 15-20%, infuse that. Answer to the second question, do I invest now? Yes, you can invest, not on one time investment. Do a staggered investment, either by way of SIP or STP. STP is nothing but systematic transfer plan. How many months or how many years I need to do that? Probably 1 year's time. You need to do a systematic transfer plan or SIP, systematic investment plan. Then you stay put for another 3 to 4 years time. You will generate fantastic return. Right? So the key factors you need to look at in the market is, the market is liquidity driven. Find out any action which will have an impact on liquidity. Number one. Number two, what is the government spending on infrastructure project? If the government spending on infrastructure project is higher, the market will move up, because that will have a cascading effect in the economy grow. Market valuation is higher, yes, P is around 36. PE means price to earning ratio, P by E, price to earning ratio. Whether the price is correlated with the earnings, it is highly valued or lower valued. That is, now the market is overvalued. It is around 36 PE. It is not a good PE to invest. That is the reason we say invest in staggered manner. Do a STP or SIP in a good stock or good mutual fund. Go with a good advisor who will advise. Right? So the answer to the second question, if you want to invest, you can invest, but STP or SIP mode. Right? And if you wanted to look at how the market is going to go ahead, I request you to look at three factors. One is, what is the government actions or government intention to spend money in infrastructure project. If they are spending more money in infrastructure project, the economy will do well, market will go well. What will be the actions which will have an impact on liquidity in the market, that you need to watch. That thing is the corporate earnings, that is also you will have an eye on that. Three factors: liquidity, government spending, corporate earning. These all three are correlated, and if government going to spend more money in infrastructure projects and they will maintain or help the banking system has got more liquidity in the system, and the corporate start borrowing it, these are all the good indicators for the economy to grow. Positive signal to the market will start moving up. Okay, stay invested, don't panic, wait for the volatility, any corrections, any downward movement, be happy. When the market down, you should be happy to invest. When the market goes up, you should take decision on book profit. This is a fundamental rule for Indian market. Thank you so much.